The first situation where we might need a memo is for a capital contribution by the owner of an asset other than cash, and we'll need to talk about this concept of the fair value. So, what makes owner's equity go up and down? Well, because they're separate entities, the business and the owner can engage in transactions with each other. So, in the eyes of the law, they are separate entities. We've got the owner over here and the business here, and the owner can give the business anything. So, we've dealt with cash a lot, but they could also give a car or a property or anything. And we call that a capital contribution. When the owner gives assets to the business, they are contributing to the equity of the business. When the owner contributes cash to the business, which is we've dealt with that a lot, there is already a source document for that. So that is just an example of a cash receipt. So we will give out a business generated receipt, or there'll be an FPOS receipt, something like that. And then we can also match it up with a bank statement. But what about when the owner contributes an asset other than cash, like a car, property, laptop, or even just something small, like a coffee machine for the office, something like that? Well, what amount should be used? Let's take an example. Let's say the owner is going to give this van to the business. And what the problem is we need to look at, well, as the entity of the owner, let's say in 2020, the owner purchased this van brand new for $35,000 plus GST. But they're contributing it today, so we need to determine what value. What value should the van be valued at today for the business? Should it be $35,000? Well, there's going to be a source document for that, so that's very, we can prove it, it's very verifiable, but we actually wouldn't use that $35,000, and that's because the owner and the business are separate entities, so what the owner paid in the past is not relevant to the business today. So if we're not going to use that amount, well, we need another amount, and that amount has a name. It's called the fair value, and what it is, it's when the owner gives the business an asset other than cash, we're going to use the fair value, and it's an estimate of the current economic resources or benefits the asset has left, which essentially, if you want to think about it, is basically its market value if the asset was sold today. So let's just go back to that example. We've got the owner as an entity with the van. They bought it in 2020 and they paid $35,000, so it's reasonable to assume the economic resources or benefits of that van were $35,000. But let's say today, the owner thinks that there's probably about $25,000 worth of economic benefits left, that's probably what they could get for it if they sold it today on the market. So we need to factor in this value here, which is called the fair value. The issue becomes is that we have a source document to prove the 35,000 from 2020, but this one here is an estimate. So that's good and bad. So we're going to have some issues with that. And that means there's some arguments for and against using the fair value. So know your accounting theory. What are the arguments for? Well, relevance. The fair value estimates the current economic resources of the asset today, so it impacts decision making. It's clearly the most relevant figure today. Not what the owner paid in the past. That's not relevant to today. What else? Faithful representation. It represents roughly the real world value today of the asset, because that's literally what it is. It's an estimate of the market value today. And lastly, accounting entity. We should use fair value because it's the relevant amount for the business entity, whereas the purchase price from the past is really only relevant to the owner as an entity. So what are the arguments against fair value? Well, they are, first of all, verifiability. As soon as we use an estimate or a guess or subjectivity, we can't verify that with a source document. So it's just not verifiable. But we could also flip this faithful representation around and say, look, if we get the guess right about today's value, yeah, it does represent the real world value. But if the estimate is wrong or biased, like the owner just says it's worth way more than it really is, it actually won't represent the real world value. So we've got arguments for and against the fair value. So what we want to do is think about what type of questions we might get for that. And that's a really good discuss question where we have to give one side of the argument and the other side of the argument.